I want you to try a terrifying thought experiment. Imagine waking up in the year 2056. We're driving flying cars. We're vacationing on Mars. Your grandkids are asking to borrow the family spaceship. The world has changed completely. But then, you walk to your mailbox. You open an envelope. And your stomach drops. Because you realize you are still paying for that vacation you took back in 2024. It sounds like a bad joke, doesn't it? But if you are sitting on $25,000 of credit card debt right now, and you're only making the minimum payments, that isn't a joke. That is your mathematical reality. If you stick to the minimums, you won't just be in debt for 30 years. You will pay back nearly double what you originally borrowed just in interest. The bank will own your financial future for 3 decades. The math is broken. The game is rigged to keep you on the hamster wheel forever. But here's the plot twist that the banks definitely don't want you to know. $25,000 isn't just a scary number. It is actually a financial sweet spot. It's the exact amount of debt where a specific, boring, totally unsexy, government-regulated program becomes a superpower. It's a strategy that can save you $40,000 in interest, protect your credit score from being nuked, and get you debt-free in exactly 48 months. Today, we aren't just talking about cutting lattes. We are going to dismantle your debt with surgical precision. But watch closely, because there is an evil twin version of this program that will ruin your life, and I need to make sure you don't accidentally sign up for it. Buckle up. We're going to war with your debt.
Path 2. The DIY hero. This is the avalanche method. You refuse to get help. You tighten your belt, cancel Netflix, eat rice and beans, and decide to pay a fixed $815 a month no matter what. This is heroic. And mathematically, it works. You'll be debt-free in 4 years. But because your interest rate stayed at 24%, you still burned $14,000 in interest. That's $14,000 set on fire. That's a decent used car. That's a down payment on a house. That's gone forever. We need to do better.
Squash Path 3. The Strategist. This person admits the math is rigged. They use the program we are discussing today. They negotiate the rate down to 8%. They pay a fixed $650 a month. The result? They are also debt-free in 4 years. But here is the magic trick. They only paid $6,200 in interest. Look at that difference. The strategist gets out of debt in the same time as the hero, but with a lower monthly payment, and keeps $8,000 more in their pocket. Mathematically, this is the only logical choice. So what is Path 3? It's called a debt management program. A DMP is not a loan. It's not bankruptcy. It's a peace treaty. It's run by nonprofit credit counseling agencies. Think of them as diplomats between you and the credit card giants.
Here is exactly how it works. You hire the agency, usually for a small fee, like $30, $50 a month. The agency calls up American Express, Citi, Discover, and Capital One. They say, listen, this person owes you money. They want to pay you back 100% of the principal. They aren't trying to stiff you, but they cannot do it at 24% interest. If you keep the rate there, they might go bankrupt, and then you get nothing. The banks run the numbers and realize something is better than nothing. So they agree to lower your rates via something called concession rates. I'm not talking about a 1% drop. I'm talking about dropping from 28% down to 8%, sometimes 6%, sometimes even 0%, depending on the creditor. Instead of juggling 5 different due dates and 5 different minimum payments, you make one payment to the agency. They distribute the money. Suddenly, your monthly payment isn't vanishing into thin air. It's actually killing the debt. Your $650 payment becomes a wrecking ball. Now pause. Stop washing the dishes. Stop scrolling. This is the part of the video where people ruin their lives. There is an evil twin to this strategy. It looks almost exactly like it, but it is dangerous. It is called debt settlement or debt relief. You've seen the ads. Guy in a cheap suit yelling, "We can settle your debt for pennies on the dollar," or "The government wants to forgive your Visa bill." Spoiler, they don't. Here is the dirty secret they don't tell you in the commercial. To settle a debt, the account has to be in default. So the settlement company will take your monthly payment, put it in a savings account, and tell you to stop paying your credit cards.
They force you to crash your own credit. Your phone will ring off the hook with angry collectors. You might get sued. Your wages could be garnished. And here's the kicker. If they actually succeed in settling your debt, let's say they get $10,000 forgiven, the IRS considers that $10,000 as taxable income. So you get hit with a massive tax bill at the end of the year. Do not do this. Unless you are already months behind and on the verge of bankruptcy, avoid the evil twin. We want the good twin, debt management. We want to pay back what we owe, save our reputation, but cut the interest rate. Always look for the nonprofit status and NFCC accreditation. That's your green flag. Okay, back to the good twin. Is it perfect? No, there is a catch. And for some of you, this is a deal breaker. To get these 8% interest rates, the banks demand a sacrifice. You have to close the cards. You cannot use them anymore. You cannot earn points. You cannot keep them just in case. For a lot of us, that is terrifying. We are conditioned to think of credit cards as our safety net. When the transmission blows on the car or the dog eats a sock, we swipe the plastic. If you close the accounts, you feel naked, vulnerable. This is why I tell everyone, do not start a DMP until you have a baby emergency fund. I want you to have $1,000 to $2,000 in a boring savings account before you make the call. Because once you cut up the cards, cash is your only oxygen. If you don't have that cash buffer, the first time you get a flat tire, you will panic, drop out of the program, and be right back where you started.
This leads to the biggest question. Will this ruin my credit score? It's called the J-curve. When you first close the accounts, your score will dip, maybe 20 to 40 points. Why? Because you lost your available credit limit. But then, as you pay down that balance by $650 every month, your debt-to-income ratio improves and your utilization drops to zero. Within 12 months, most people see their scores rocket past where they started. You are trading a temporary dip for long-term freedom. So, you're ready to do this. You're ready to kill the dent. How do you actually sign up? Here is your literal to-do list for tomorrow morning. Step 1. Gather the intel. Get every single statement. You need the exact account numbers and the balances. If you call them and say, "I think I owe about $5K on the Visa," they can't help you. Be precise. Go to NFCC.org. That's the National Foundation for Credit Counseling. You want the big, boring nonprofits. Agencies like Money Management International, MMI, American Consumer Credit Counseling, ACC, or GreenPath. These guys aren't scammers. They've been around for decades. Step 3. The script. Call 2 of them. The call takes about 45 minutes. They will verify your income to make sure you can afford the program. Then, ask the magic question. Based on my specific creditors, what are the concession rates? That's industry speak for, what will my new interest rate be? Compare the quotes. Agency A might get you to $650 a month. Agency B might get you to $630 a month. Pick the winner.
This is where most people fail. They forget the pain of the treadmill. You have to remember the math. Every month you make that $650 payment, you are buying your freedom back. Open your statements. Look at the interest charged section. Seeing $12 in interest instead of $400 is the greatest feeling in the world. It's addictive. Use that high to keep going through the messy middle. $25,000 is a mountain. It feels heavy. It keeps you up at night. It causes fights with your spouse. It steals your peace. But you don't have to climb it alone, and you don't have to climb it with a 50-pound backpack of 24% interest strapped to your chest. A debt management program is the Sherpa that carries the weight so you can actually reach the top. Imagine 48 months from now, the payment is gone. You have an extra $650 every single month. That's $7,800 a year. That's a maxed out Roth IRA. That's a family vacation paid in cash. That's freedom. I want you to comment below. When you are finally debt-free, what is the first guilt-free purchase you are going to make? If this video saved you from the evil twin or helped you fix your math, hit that like button so YouTube shows it to more people who need help. Subscribe if you want to keep your money, not give it to the banks. I'll see you in the next one.